Hey, you may have seen this article that just hit from The Hill, which is JPMorgan Chase to raise borrowing standards for home loans. Now, look, we are in a new time in our economy, and so things are changing rapidly. And seeing this article might have scared some people, and some people might not understand what that actually means for them. So what we're going to do today is we're going to break down this article and talk about the changes that JPMorgan Chase has announced. We're also going to look and see how this affects you as a consumer, and we're going to see what this means for the future of lending moving forward. Now I'm going to bring on a special guest, Aaron Kovac with CMG Financial. But first, let's break down this article and see what exactly is happening with JPMorgan Chase. All right, so let's go through and break down this article. The nation's largest lender by assets and fourth largest mortgage lender in 2019 will require new mortgage applicants to make a down payment of 20% and have a credit score minimum of 700 FICO Score. Now, the bank would not disclose its current minimum requirements, but current average down payments are approximately 10%. So if you're putting 10% down or 5% down, according to these changes with JP Morgan, you can no longer do that. But what does that mean to you? If you were going to use Chase Bank as your lender, you would now, instead of having like a 640 or 650 credit score to be a minimum, now it has to be 700, and you have to be putting 20% down. You used to be able to put down 3 or 3.5% down. So does this mean every single lender is going to do the same thing? All right, let's go over to my friend Aaron Kovac with CMG Financial and get some insight from him. Here we go. Awesome. Well, I have Aaron Kovac with me with CMG Financial. Aaron, until about a couple weeks ago, was actually with Chase Bank, so maybe he can help answer some of these questions. Right. Aaron, good morning. How are you?
I'm doing well, Jeremy. How are you?
Good. So I sent you the article yesterday, and we actually talked about this article. Yep. But what does this all mean with Chase temporarily changing their lending guidelines, and what are you seeing there?
A couple things that come to mind with regard to this latest news from Chase is they're raising their minimum requirements to 700 minimum credit scores and 20% down payment. Now that's going to present an issue for a lot of people out there who are looking to get their loan through the bank where they do their banking. Lenders are going to look at various different criterias, ratios, different things to assess risk. And so with everything that's going on in the economy, we've seen in the last month unemployment rise up to 16 million within about a 3-week span of time. That took, during the Great Recession from 2007 to 2009, 18 months for unemployment to reach those numbers, and we did it in just 3 weeks. So there's a lot of risk involved with lending money to anyone right now.
So, Aaron, that's a great point. So what is the difference between a big institutional lender like Chase Bank and yourself, and what does that mean for the average buyer? Do the changes at Chase Bank affect the average buyer?
Oh, yeah. So the main difference between Chase versus CMG and any other mortgage lender out there is that they are a bank lender, whereas CMG is a mortgage lender. Basically, what it comes down to in the difference with Chase versus CMG is Chase is juggling a bunch of different balls all at once. They do lending for home lending, they do business lending, they do deposits and investments.
So what Chase does differently is when they create their loan, they are the servicer at that point. So when they're lending that money out, it's actually staying there. With a company like yourself, you have like a warehouse line of credit, right? So you're making sure that those loans fit a certain criteria, that way they can be sold in the secondary market. So, right. So let's say somebody is looking to buy and they don't have a 700 credit score. What changes has maybe like a CMG made or other lenders made that's different from a Chase Bank?
Yeah, so some of the other differences that we've seen in the last month or so is lenders taking a big step back from doing jumbo loans, and everybody except the big banks has stepped away from that, and that's because of basically how we do business compared to how they do business. The big banks, like I said, Chase being the largest bank by assets, they have a ton of cash that they sit on and they can continue to operate on for the purpose of originating jumbo loans. They can just portfolio those. Whereas mortgage lenders such as CMG and just about everyone else who's not a gigantic bank, they're operating off of warehouse funds, which if you just want to imagine like a several $billion line of credit, that's what they're using to originate their loans on. And so as soon as that loan closes, they then sell it to the secondary market so that they can get their funds back to replace those warehouse funds.
So with Chase changing their minimum down payment to 20% and their minimum FICO score to 700, what have other lenders changes been? What are they doing for minimum FICO score? What are they doing for minimum down payment like yourself?
Yeah, so we really haven't seen many changes at CMG compared to most lenders. The only change that we have seen that has been significant is that we have, at least put a temporary hold on doing jumbo loans right now. But everything else is still business as usual. Other lenders out there, including other mortgage lenders like CMG, but not CMG, they have increased their minimum credit scores to 660 or even 680 on government loans, VA, FHA, USDA, or DPA, down payment assistance.
Why are lenders like yourself or other lenders changing those FICO scores from 620 to 680? What's the reason for that?
Why they're increasing their credit scores, minimum credit scores to 700, as well as down payment to 20%. Lenders across the board since a month or two ago, right at the beginning of the year, have been seeing loan activity spike 300% because of what interest rates have been doing since the beginning of the year, being close to all-time lows and even going a little bit further below that. Lenders right now are so inundated with the amount of refinance applications that they can barely get their head above water. Some lenders out there have been pushing their refinances to 4 to 6 months, telling clients, we'll lock you at these super low interest rates, but you have to know that your refinance is not going to be done for 4 to 6 months. Now, lenders like Chase, they're also experiencing a lot of that, maybe more so than a lot of other lenders, just because of how big they are, how many clients they help throughout the country. But also because of the unemployment, lenders are seeing an increase in requests to delay payments by 1,900%. That's 1,900%. So when I left Chase a month ago, if somebody who had a mortgage with Chase called in to the servicing hotline, they were sometimes on hold for 2 to 2.5 hours before they even got a hold of somebody. So what raising the 700 score and minimum down payment requirements do is they allow lenders such as Chase to focus more on the clients that they already have in process so that they can provide a better customer experience to those clients without continuing to take new applications, which might just make the whole process a lot less smooth for everyone across the board.
Okay.
Now, at CMG, we haven't yet experienced any of those things to where we've had to, we don't have to increase our credit scores or our minimum down payment requirement. It's still business as usual, but those are some of the things that are coming into play with banks such as Chase that are doing what they're doing right now.
So that's good to know, because I think if a consumer is looking to buy a home and they're seeing this article about Chase, they're seeing all the changes in the economy, people are losing their jobs, and we are seeing some definite not good side effects of this. It is good information that they are still able to purchase if they are looking to purchase. Now, let me ask you this, Aaron. Obviously, you and I are both in the business. Is now still a good time to buy, or should people hold off?
We're at historically low interest rates right now. So money has never been cheaper to borrow than it has been right now. And so some of the advice that we're giving out to people, if they're looking to buy, lock that rate right now. A lot of lenders out there like CMG, we have a float down option. So if they go lower, we can explore, taking advantage of a lower market rate during the process. If they're refinancing, we're probably, giving them the flip of the coin, whether they want to float it or not. But we don't see interest rates going anywhere anytime soon, at least not until this pandemic thing is over, maybe even beyond the election, before we see them start to rise up again. But right now, there has not been a better time to buy based on interest rates than right now. I would also, throw the ball back to your court, is what you're seeing in the real estate market. I think that we're seeing a transition from a seller's market to a buyer's market. I think that this whole situation is giving buyers a lot more advantage when going to actually make those offers on homes now. Correct me if I'm wrong.
Yeah, no, I mean, The Austin market is a different market compared to other markets. I mean, in a lot of different markets right now, you can't even sell real estate. They're not considered essential in some markets. In Austin and Texas, we are. So, but that being said, I'm looking at the overall inventory, and this is the time of the year where we have a lot of buyers flood the market, and we have typically lower interest rates. So buyers do have a tougher time right now in this time of year purchasing. They're going to multiple offers. I think for what I'm seeing is if you are considering buying, again, rates are lower, so that does help your purchasing power. These changes will take some of the buyers out of that pool that were maybe a 640 credit score. If some lenders are going to 680, they're going to have to go to different lenders. I think it's going to take some buyers out of that pool. And we still do have really low inventory. So it's kind of a mixed bag. I think depending on where you're going to buy, yes, it's a phenomenal time to buy still. If you're looking to sell, I still think you're getting good money for your home. I mean, I'm still seeing multiple offers, but maybe not 10 offers on a home, 3 or 4 offers on a home. So whether you're buying or selling, you're on one side, you're good because you're going to make a good return on your home and still not have to overpay on the next home. That could change, but things are where they are. I just did 2 videos on this, and I'll link them at the end so people can watch those and come up with your own decision on that. But Aaron, thanks for your time, man. I really appreciate it. If somebody wants to reach out to you, what states do you lend in, and where can they contact you?
Yeah, absolutely. So if somebody wants to get in touch with me or CMG in general, they can go to my website, which honestly can be found just by Googling Aaron Kovac, CMG, and it should be the first thing that pops up.
That's the video, Jeremy Knight with the Knight Group. I appreciate your time. Make sure you like, comment, subscribe on our YouTube channel. If you find these videos informational, definitely drop a comment below. If you have more questions, Aaron and I will definitely answer those questions, so leave those in the comments below. I got 2 really great videos on either buying or selling in this market. Have an awesome day.